Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
It's been a wild week on Wall Street with the Iran strikes hitting day 7. Let's take a look at how the year-to-date markets are doing. Crude oil is up 38.3%. Plus, what happens today? Silver up 17%, gold up 18%, Bitcoin down 20%, Magnificent 7 down 5%, the Russell 2000 still up 3%. But with hopes of interest rates being cut soon fading, that may not hold. The Dow Jones Industrial Average is down 1% for the year. The S&P 500 is down 0.5%, and the Nasdaq's down 2%. Crude oil is at $90 a barrel today. That's up 11% today. Brent crude is up 8% to $92.47. So we've cracked through 80 straight to 90 this week. Jobs are falling. Spending is too. That's a problem with oil creating inflation. The $11.7 trillion global travel industry is caught in a global crossfire of conflicts. It's been a rough year for the travel industry. Starting with 3 days into the year, the United States struck Venezuela, closing airspace throughout the Caribbean. People got stuck on vacation. In February, flights were grounded in Mexico. The killing of a cartel leader by the Mexican government shut down a lot of resorts and airports, thus creating roughly 9% of their economy, tourism industry. This is a chaotic time, most chaotic since 9/11. 20,000 flights were grounded since Saturday plus. The Fairmont Palm Hotel in Dubai was hit with debris, injuring 6,300 cruise passengers were stranded in Dubai. Inquiries on very expensive cancel for any reason travel insurance shot up 18-fold this week. Oil hits a 23-month high. The Minister of Qatar warned the prices could reach as high as 150. That got me thinking, what is the number per barrel that's going to hurt the United States? Most economists believe the U.S. economy can absorb the current shock unless oil prices rise significantly from today's levels. The key risk threshold appears to be around 125 per barrel. The U.S. economy entered the conflict from a relatively strong position. Real GDP grew about 2.2% in 2025, and many economists expect growth could approach or exceed 3% if consumer spending remains resilient this year. Structural changes in the energy production also reduce vulnerability. The United States is now the world's largest oil producer and a net energy exporter, meaning higher global prices do not affect the economy as uniformly as they once did. If crude oil rises to around $125 a barrel, the impact on the U.S. economy would likely remain manageable but noticeable. GDP growth could be hit roughly 0.8% to 1%. Inflation could rise by 1.5 percentage points. Gasoline prices could increase by roughly $1.25 plus a gallon. For context, the U.S. average right now on gasoline prices is about $3.25, far below the peak of just over $5 a gallon in 2022. How do you want to play defense right now as oil spikes and markets slip? Every now and then, a particular asset is afforded greater heft than usual in determining broader market machinations. Right now, that asset's oil. As the war against Iran compromises supplies of crude, traders are adjusting valuations across asset classes, seemingly with every tick of the Brent crude. The current dynamic poses a big problem for investors. It's because the latest oil price surge is shifting correlations. The typical 60-40 portfolio is designed to provide growth from stocks and income from bonds. It's considered relatively stable because if equities fall as a result of economic downturn, that would normally boost the prices of bonds. However, this week there's been occasions when the jump in oil prices saw both equities and bond prices slip. Oil prices are surging as geopolitical risk hits supplies and not because of hopes of stronger economic growth, which would boost demand. Higher energy costs may boost inflation, making bonds less attractive. We've seen a renewed burst of inflation expectations akin to what we saw in 2022 and 2023 in the fallout from the Russia-Ukraine war. Opportunities remain for investors willing to sift through the wreckage on Wall Street. Have you ever played defense in stock markets? Even some of the typical havens investors turn to in volatile markets are still getting hit hard. Sell first, ask questions later, pull back. Take a look at gold. The yellow metal was down with most other assets this week because of the stronger dollar, but gold is still up 20% for the year. Gold mining stocks have also posted strong gains in 2026, with major holdings such as Newmont Mining, ticker symbol NEM, Agnico Eagle, AEM, and Anglo Gold, ticker symbol AU, helping drive performance of the GDX. That's a ETF called the Van Eck Gold Miners. The ETF remains up more than 20% year to date. Gold prices could find additional support if the dollar resumes weakening, since a declining dollar often makes the metal more attractive to buyers. Now, what can you do if you want individual stocks? Major companies like ExxonMobil and Chevron, they're trading near all-time highs. They should continue to benefit from rising crude prices. So could oil and natural gas pipeline providers such as Valero and Williams companies. Aerospace and defense stocks are getting a lift from geopolitical volatility, including RTX, Lockheed Martin, Northrop Grumman, L3 Harris, and Honeywell. A multi-week air campaign should be good for defense companies, as the United States is deploying new weapon systems like one-way drones. At minimum, weapon stocks will be depleted and have to be rebuilt. Then you get into dividend players like Verizon, one of the big winners this week. It yields 5.6%. Investors are flocking to income in times of uncertainty. Consumer staple stocks known for their dividends and defensive characteristics have names like Coca-Cola, ticker symbol KO, Philip Morris, ticker symbol PM, Procter & Gamble, ticker symbol PG. Other staple companies that have attracted investor attentions include PepsiCo and Walmart. Walmart, though, rising prices and slowing consumption could limit further multiple expansion if interest rates remained elevated. Investors seeking income should balance defensive positioning with valuation risk and a little bit of macroeconomic uncertainty. Dividends make sense, though, right now. Weeks like this highlight the need for steady income. There's some alternative funds which aim to mimic market-neutral strategies of hedge funds designed to minimize volatility. These are managed future spaces. They've been relatively bright spot this year with several funds outperforming the broader equity market. There's one called the DBI Managed Future Strategy. Ticker symbol is DBMF, up over 5% this year with a 4% yield. The Simplify Managed Future Strategy, ticker symbol CTA. It's an ETF. And there's one more called ticker symbol is KMLM. It's the Crane Shares Mount Lucas Managed Futures Index Strategy. They've all delivered strong performance compared with broad market benchmarks. However, these strategies still carry meaningful risks. You could also look at something like a Schwab Dividend ETF. There's one that's tied towards defense and energy stocks. It's the Schwab US Dividend Equity ETF. This year, you've gotten a 16% return year to date. The index fund, which pitches itself as a low-cost fund offering, is suitable for the core holding in a diversified portfolio. I'm saying be a wise investor and be prepared for all market conditions. If you want to learn more about financial planning and your retirement, come to an event March 11th, 6:30 to 8:30 in Lafayette. Learn about navigating wealth in uncertain times, wealth preservation, retirement planning. It's a free in-person event to better understand today's markets and help you feel more prepared about your next moves. You'll get a free preliminary plan after the event. I did a preliminary plan 5 years ago, and I started changing my wealth accumulation strategy into a wealth management strategy. I saw some areas that were a little bit underfunded, and some product that I wasn't using. Sign up for the event at robblackshow.com. I have a great show for you today.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
One of the big stories since about October of 2025 is what is going to happen with AI and its relationship to employees as well as firms, especially the software firms has been a big one this year. Companies like Salesforce, Adobe, Intuit. How much will they be able to charge in the future? What will their business model look like? Wall Street's taking the sell first, ask questions later approach. Investors and individuals have always been spooked by technology and revolutions. The Industrial Revolution replaced America's farmers on a lot of levels, gave them jobs. Then there used to be like AT&T had operators who had to connect you almost physically. We used to have milkmen. We had typists. Elevator operators. When you would go to a bowling alley back in the day, when the pins needed to be reset after you threw the ball, someone actually had to physically load them and do that. So this is nothing new, but it does deserve to be talked about. This week I saw a story about mortgages in 47 seconds. That was a stunner. Let's read about that one. I wanted to hear more. There's a company called Better. They're a mortgage platform. They've partnered with OpenAI to launch an app within ChatGPT that will dramatically reduce the time it takes to underwrite a mortgage or home equity loan. The app takes Better's mortgage engine and combines it with OpenAI's models to speed up the underwriting process for loan officers working at banks or mortgage brokers or fintech firms. Taking the mortgage underwriting process, which we've all experienced, or at least I have numerous times, from 21 days or a month down to 47 seconds would create a lot of value and appreciation, but it would probably replace some jobs. Creating a mortgage has been one of the most time-consuming corners of the American finance, with lenders relying on dozens of steps that can take a week to complete. In 2008, after the financial crisis, big banks like JP Morgan Chase receded from the U.S. mortgage market, leading to the rise of non-bank players like Rocket Mortgage and United Wholesale Mortgage to pick up the slack. And they got hit this week when this story came out. United Wholesale Mortgage and Rocket Mortgage. So that's an area where artificial intelligence is tapping into a market. The U.S. home loan market originates more than $1 trillion in mortgages every year. They say the mortgage underwriting typically taxes us, the people who are buying a home and getting a mortgage, of about 1.5 percentage points. That's a $20 billion hit the American public is taking. So I think that's an area where AI could disrupt, maybe for the positive. Now, AI disruption, what it means for investors and you. Economists at Goldman Sachs estimate that generative AI could expose as many as 300 million full-time jobs globally to automation, potentially automate up to 1/4 of current work tasks. That doesn't mean that these jobs disappear entirely. In many cases, AI simply is going to allow fewer workers to produce more output. The same Goldman Sachs research suggests widespread AI adoption could increase global GDP by as much as 7% over the next decade through productivity goal gains. And that, my friend, would create higher stock markets. But there may be a situation where there's a sell-off in software companies, and then they start taking that AI and putting it into their software and making it better. Businesses rarely adopt new technology purely for novelty. They adopt to cut cost and improve productivity. AI offers both. A junior analyst might earn $80,000 to $120,000 a year, whereas a generative AI tool might cost $20 to $200 per month. If AI can perform 30 to 50% of the work, companies will have a very strong incentive to reduce hiring, which will lead to smaller teams, fewer entry-level hires, and slower wage growth. In many industries, AI may function as a productivity multiplier rather than a full replacement. But productivity gains often translate into fewer workers needed overall. This isn't theoretical anymore. At fintech firm Block, Jack Dorsey recently announced plans to cut roughly 4,000 employees, citing productivity improvements from artificial intelligence systems. The company reported strong revenue growth, meaning the layoffs weren't due to financial weakness. AI allowed the company to operate with smaller teams, doing more work. Technology could slow hiring and reduce certain roles for sure, even if the total headcount remains the same. The results may not be mass layoffs, but fewer new hires and much more needs for higher productivity per employee. Some jobs will be safe, some jobs will not be. Think about it. Manual skills, physical presence, real-world interaction, construction jobs, building homes, roads, and infrastructure requires physical labor for now. There will be some things that can be turned robotic in construction, but not many. Jobs like hairdressers, childcare providers, elder care workers, they too rely heavily on human interaction. AI may assist with scheduling or paperwork, but it can't replace the human element everywhere. I wish, and this is one of those funny things I'm telling you about me, I wish I had become a chef. It's the dream job that I never did, but I love cooking, and I love the process of buying groceries and cleaning the kitchen and prepping the food and cooking the food, eating the food, cleaning the kitchen, and doing it again the next day. Now, there's some obvious winners in all AI automation. It's companies like NVIDIA, they're the chip maker. NVIDIA's GPUs have become the industry standard. AMD, Broadcom, Taiwan semiconductor manufacturer. Those are the four core cornerstones, if you will, of my AI strategy. And then I add in a little bit of Microsoft, Amazon, and Alphabet, who are spending tens of billions of dollars building AI data centers filled with these chips. In cloud computing, the winners will be Microsoft, Amazon, and Alphabet. Cloud platforms allow businesses to integrate AI tools directly into their workflows without investing billions in infrastructure. Some of the companies that will embed AI directly into everyday business software names include Salesforce, ticker symbol CRM, ServiceNow, ticker symbol NOW, and Adobe, ticker symbol ADBE. Some will be winners and some will be losers. In the short term, they might be losers as we start guessing. AI assistants can draft emails, they can generate reports, they can analyze customer data, they can automate internal workflows. Two of the companies that do automation and robotic process software include UiPath, ticker symbol PATH, and Appian, ticker symbol APPN. That's a category of AI winners, which includes building software that automates routine business processes. I have someone clean my hot tub every month, and the guy who cleans the tub sends a note to the secretary. The secretary sends me an email. That can all be automated. Businesses that are going to get hurt bad, I believe, are the consultants, like Accenture, ticker symbol ACN, IBM, Cognizant Technology Solutions, ticker symbol CTSH, and Globant, ticker symbol GLOB. If AI increases developer productivity dramatically, clients may need smaller consulting teams. Legal information services, we talked about mortgages being automated. How about maybe even legal information services? There's one company that owns LexisNexis. It's called Relix, RELX is the ticker. Large language models can increasingly perform legal research tasks that once required expensive subscription databases. You can find the podcast where you find podcasts, and you can come meet me at my only event on the East Bay for the rest of the year. It's going to be Wednesday, March 11th, 6:30 to 8:30. It's a wealth preservation retirement planning event. Stay tuned. I'm going to be talking about it in the next segment. You can sign up for the event at robblackshow.com. It's this coming Wednesday, the 11th, 6:30 to 8:30. with me and a few other CFPs. Sign up at robblackshow.com. That's robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.
Joining me now, Nathan Rogers. He works with EP Wealth. I'm in the wealth accumulation. He's in the wealth management world. He will be at the event Wednesday evening in Lafayette, 6:30 to 8:30. You should sign up and you should come. He also has joined me and will be joining me at future Pints and Portfolios. So you'll get to know him. You'll get to like him. Let's talk about current market scenarios and things that people have questions on, Nathan. When I am approaching retirement, in my 20s, I didn't really know when it was going to happen. In my 30s, I didn't know when it was going to happen. But now that I'm in my 50s, it's going to happen. And the rule of thumb has always been, for me, 10 to 20 times your income. 20 times if you're living in an expensive area. Maybe 10 times if you're going to go a little bit slower and live in a cheaper area. What's your rule of thumb when it comes to retirement?
My rule of thumb is, I think you're very much on point with the way you're thinking about that. So mine is similar. Where it gets different is specific to the person. And this is where the financial planning piece becomes imperative, because the rules of thumb, that's exactly what they are. They're guidelines. But you run into scenarios where you'll have a pretty broad array of clients. And some of them are people who are reluctant to spend a dime. And it's just the way they're built. And then you get the exact opposite of the spectrum of people that you're worried about the sustainability of their portfolio because they want to spend a lot. And you can build the construction of the financial plan according to that individual's personal way that they use money. So that's probably the most important piece, is that the rule of thumb gives us a guideline, and then that is refined by the outcomes of the financial planning work that we do using tools like Monte Carlo, which I know you've talked about before, using tools like cash flow analysis to help people really see it. That cash flow analysis really can help when it comes to, are you the 20 times person or are you the 10 times person? Because something that most people have not spent a lot of time thinking about is what tax liability looks like in retirement. That's another factor in cash flow that gets overlooked. People tend to say, oh, I've got $10 million. Okay, if I spend $500,000 a year, that means I have 20 years worth of money. Well, you and I both know money doesn't work that way, right? Because it's not static. It's not staying in one place. There's growth occurring on the invested assets even while you're pulling cash. But you also need to factor for, okay, is that $500,000 that you're saying you need in income, including your tax liability? Because that's another factor. So that rule of thumb is a great starting point. The ending point is really deep, detailed, personal focused financial planning.
React to what I'm about to say. The Monte Carlo scenario, it blew my mind when my CFP showed it to me, because I've got enough money that the Monte Carlo scenario projected if I lived till 94, 95. I had a 100% chance I'm going to hit my retirement. It blew my, as an 18-year-old kid, I never, ever dreamed of that. I'm going to be leaving a ridiculous amount of wealth for philanthropy. I'm going to be leaving a lot of wealth to my kids so that they could live a good and full life. The Monte Carlo scenario is what I want you to react to. When I look at it, I smiled. And that's something you're going to do with people that you meet at this event. You're going to show them their best case scenario, their normalized scenario, and their worst case scenario. Let's talk a little bit about Monte Carlo scenarios. And do you put a lot of faith in that?
I think they're like what we talked about with the rule of thumb guidelines. Yeah, it's not possible to make anything perfect when you're dealing with the future, because the future is a series of a cascade of unknowns. There's all sorts of things that can happen, but where Monte Carlos are particularly useful and why they're worth doing is because they factor for that. And so when you run a Monte Carlo and you run, like you said, 1,000 or more different scenarios of a person's situation, what it's taking in for inputs is that person's actual life, their wealth, their spending, their expenses, all of it placed into a modifier that treats it as though there's 1,000 different possibilities, not just 1,000 possible years of experience in the market, but 1,000 lifetimes of experience in the market, and what would happen when you give a wide variety of potential market circumstances that's going to include horrible markets and wonderful markets and everywhere in between, and it's distributed somewhat randomly throughout those 1,000 different lifetimes to get you to an answer of what the probability is that your money is going to last. So when you think about that, it can't give you a perfect answer, but it can give you something very valuable, which is a kind of a median likelihood of where you're headed. So that number you referred to, Rob, yes, seeing yourself at a 9-figure net worth, which is amazing, by the way. Congratulations to you.
I know it's embarrassing to talk about, and it's so wild to think about. But thank you. Move on.
It's incredible. So when you see that, here's what makes that valuable is that we're going to show it to you at different levels. And my favorite one is the 50% median level, which means that in these 1,000 scenarios that we ran, 1,000 lifetimes, think of it as lifetimes, because it's not just 1,000 scenarios, it's 1,000 lifetimes of scenarios with your data in it, is that median number says that the halfway in between point of where all the results ended up across all these 1,000 lifetimes lived is here. I think that's a pretty remarkable number to be able to come up with as the target of what somebody's future potential lifetime portfolio value would be, because it's giving you the direct in the middle of the data sample number. That's powerful, and that is good for guidance. We're not going to go so far as to call it a profit example, but we're going to say, hey, this is what's possible. And what it guides us on is how we need to think about this. Rob, in your case, as is true with many of our clients, you're going to be running into issues that may not seem obvious today, which are, I'm going to have more money than the government allows me to have before it starts taxing me on my estate value. And that means we need to do some other planning. It's not just the Monte Carlo and the financial planning, but we need to do some advanced estate planning. This isn't just trusts and wills, but this is going into deeper levels of specialized types of trusts that help factor for shifting parts of your wealth outside of your personal estate to additional estates. Those could be the estates of your children. They could be completely removed types of trusts, irrevocable trusts that exist outside of a personal estate, but ways of preserving that wealth so that you can mitigate the amount of tax you're going to be subject to.
So I have a question for you. And again, we don't plan these interviews out, which is fun. Part of the estate you're talking about, my kids, and I'm using me as an example because I know a lot of our listeners are in similar scenarios, maybe not as fortuitous as mine, but part of my worry is that my youngest kid likes to do little prediction markets because everyone else at his school is doing it. And that's short for gambling.
Yeah.
That's one area that could become a problem. Now, again, I think there's a statistic like 1 in 4 kids don't turn out the way you want them to. And when you're talking about significant amount of wealth, I was talking with my financial planner, and EP is starting to do a thing where when they get a client, a relationship, they start thinking about the future, the children, and how they're going to inherit wealth, and making a financial plan with them so that it's continuous, and that when I'm long dead, it's still working, and it's still working in the right way that I would have wanted it to while I was overseeing it and being part of the process. Any thoughts on that estate planning angle that I just brought up? Because I'm sure you see it with your clients. Lots and lots of questions. And like I said, not all kids turn out the way we expect them to.
Rob, I've heard you talk about them, and I'm lucky and fortunate to have some great kids of my own. But you are, and in addition to being, even if you do have good kids, you can't predict every outcome. There's going to be kids that run into natural struggles, even kids that are very smart, very capable, that run into natural struggles. Or like you said, this prediction markets thing, which I have my own very strong feelings about. I'm not the biggest fan of them. I like investments far better than I like gambles or bets. But at the end of the day, we have to think about, we plan for our children in a way that also protects them. For example, with your kids, and I think this is part of maybe what you were getting at, is if they're going to inherit what is going to turn out to be a very substantial amount of money, how do we protect them from the worst things that can happen? For example, receiving a massive all-in cash inheritance. The first bad thing that can happen is a great big tax. But the second bad thing that can happen is they now have access to all this capital and they blow it. We can protect them by devising estate instruments that create sub-trusts that mean that the wealth that they're going to inherit goes into a trust for their benefit that will carry on past our lifetimes and into their lifetimes, where there can be an independent trustee or another family member trustee, or even if you do have a high degree of trust, the child themselves could be a trustee or a co-trustee if you wanted to put them in charge of it along with somebody else. But where that can be a huge protective feature is having a trust that can help this child get the things you would want them to have without having access to a giant pile of cash, with which it could be very tempting to do some things that wouldn't be the best ideas. So we can build estate planning that way and protect our children, and we can combine it too, Rob. So it doesn't have to be all or nothing. You can make it very favorable for the child while also protecting a large amount of it.
I like what you're putting down, and I'm looking forward to our conversations in the future, as well as at the big event that's coming up. It's in Lafayette, Beyond the Noise, Navigating Wealth in Uncertain Times. It's really a wealth preservation and retirement planning event. You can meet Nathan Rogers. He's a chartered market technician. You can talk technicals. Where does he think the market's going? That's fun conversation. He's an MLS. He's a JD. He's on the financial planning team with EP Wealth. You can meet him 6:30 to 8:30 Wednesday, March 11th in Lafayette. CFP Stephanie Richman will also be there. I'll be there. I'll get there early. We'll stay late. We'll get all the questions answered, and we'll help set you up with a Monte Carlo scenario so you can see where you're going to fall, as well as answer your questions, what you're doing right, what you're doing wrong, what maybe you should be thinking about. People can sign up for the event at robblackshow.com. That's robblackshow.com.
These days, retirement planning is more complicated than ever. So set aside Wednesday evening, March 11th, and get ready to learn some strategies for navigating wealth in uncertain times from Stephanie Richman, Rob Black, and Nathan Rogers. This event will focus on retirement income, tax strategies, estate planning, and tax planning. If you're at or near retirement with at least $500K in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves, Social Security strategies, and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. That's Wednesday, March 11th, 6:30 p.m. at the Lafayette Library in Lafayette. Space is limited, so sign up today at robblackshow.com. That's robblackshow.com. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
I was happy to see about 1 million Americans who have 401ks that are worth $1 million plus, but that's only about 2.5% of Americans. The surge has been largely tied towards 20 years in the market, 14 to 15% of pay. With usage now, the individual is doing 14.2% of their pay into a 401k. That's great. 60% are Generation X, 35% are boomers, 4% are millennials. A little bit worrisome. The share of workers with an outstanding loan is 19.4%. About 9% of workers took out a new loan from their 401k last year for a hardship reason. Right now, in markets that are stressful, you should always have a top 10 list of things you believe in. You should have a will. You should set up a power of attorney and a healthcare proxy. You should maintain an emergency fund of 3 to 6 months. Right now, 30% of Americans couldn't handle a $400 economic surprise. Always take your RMDs when you're supposed to, because you don't want to get hit with penalties or taxes in retirement. Don't cash out when the markets tank. Know how much you spend. That's important. Check your credit report on a regular basis. I do it 3 times to 4 times a year. Take Social Security by 70. Don't wait till after that. So my kid came to me this week, and he's a smart kid. He was asking about the Iran strike and what it's going to do in the stock market. And I said, don't worry about that. I've been through 3 or 4 of these in Iran or Iraq, and I'll be okay. You'll be okay. Couple rules that I want him to know, and it was a father-son kind of talk. I said, spend less than you earn. This is a foundation for all wealth. Save before you spend. Do that 15% immediately. You've already paid yourself. Have that emergency fund. Aim for 3 to 6 months of expenses. It protects you from the financial shocks and gives peace of mind. So when there's a strike in the Middle East, when oil prices jump or markets pull back 5, 10, 15, 20%, you're not freaked out. Avoid high interest debt. Credit card debt and personal loan debt can trap you. Pay those off first when you have debt. Any debt over 6% I consider probably bad. Invest consistently, not occasionally. Regular contributions beat trying to time the market. Learn the power of compound growth. Money that earns money grows exponentially over time. So the money that I put in 30 years ago, it doubled, it tripled, it quadrupled. You learn that you can't predict what's going to happen in the world in any way, shape, or form. Wars, elections, crises, they're impossible to forecast accurately. Focus on long-term behavior, not headlines. For him, I want him to use low-cost index funds. For me, I did it with stocks. He's going to have enough wealth that he doesn't have to do homework on quarterly reports or annual reports. He doesn't have to listen to conference calls. Low-cost index funds give broad diversification. And again, this is advice I'm giving to a 15-year-old boy who has the brain of probably a 21-year-old man. He's pretty educated when it comes to financial issues. Another piece of advice, I said, stay invested. You know, in times of calamity or volatility, I did. And you won't remember these blips in history of oil at $150, oil at zero, high inflation, low inflation. You won't remember the different presidents and how they affected markets. You won't remember, I have a chart on my wall. I said, you can't even find where World War I and World War II and Vietnam and Korea and the Iraq War I and the Iraq War II is on this chart. You can't find where COVID is. It turns into a blip. The further you step away, the longer that you give yourself. Diversify across assets. You should not be in one stock or one sector or one idea. I automated my finances as soon as I could. I automatically pay all my bills when they're due. And I did things like automate investing with my 401k. And before I had a 401k, automating my IRA contributions. I set it up so every month $166 went from my bank account to my brokerage account. And then it automatically, think decades, not days. Real wealth builds slowly. Long-term thinking protects you from impulse decisions. Know the difference between saving and investing. Saving protects your money. Investing grows it. Try to earn more money if you find yourself in a career path that's not growing. So you can save, you can invest, you can earn. I do all of those. One of the biggest areas that I save money on is my credit cards because I use those credit card points and it helps me track my money, but it also gives me sometimes 5% off of whatever I'm purchasing. Don't compare yourself to others. This is a big one. He wants me to get an expensive car because all the other kids in school are getting dropped off in expensive cars. And that's just not me. I don't come from that background. I'm very blue collar who became white collar. My father was in the military. We never had too much money, but we never had too little money either. Educate yourself continuously. I'll get him the Wall Street Journal and Barron's probably for his 18th birthday. But I'll also educate him. I'll ask him to educate himself on, money. Money is a life skill. The more you learn, the more confident and safer you become. Unfortunately, he came to me recently with a flyer that got stuck in our door. That was a scam. And I'm glad that I was there for this one. And be cautious is what I'm getting at. You need to understand taxes. Knowing how income, capital gains, and retirement accounts are taxed helps you keep aware of your money. Protect your credit score. Good credit score saves you thousands on loans. Pay bills on time so you don't get a bad credit score. Try not to be emotional. It's one of the things that I do well. I pause, I breathe, I think. I don't chase quick profits, although this week I did talk about a stock that I think is attractively priced based on the last 6 months of going sideways. I still like a lot of AI names that have underperformed, and I might be building a position or even a trade in 2 of them. And finally, I tell them, invest in yourself. Skills, education, and experience. It produces lifelong returns. When you do go on vacation, it's okay to come back and look at the markets and see what happened. Try to unplug when you're on vacation, though. I love that boy. Have a long-term financial plan. A plan gives you direction when the world feels chaotic. Even a simple plan builds stability and confidence. I have an event on financial planning. Wednesday, March 11th. It's coming up 6:30 to 8:30. It's going to be my only event in the East Bay. It's all about understanding wealth preservation and retirement planning and moving from wealth accumulation to wealth preservation and making sure your retirement looks great. You can sign up for the event. It's 2 hours, Wednesday, 6:30 to 8:30, March 11th in Lafayette. Sign up at robblackshow.com. That's robblackshow.com.
Retirement planning is more complicated than ever, and it can be hard to even know where to begin. So set aside March 11th, Wednesday evening, 6:30 p.m., and get ready to learn some strategies from Stephanie Richman, Rob Black, and Nathan Rogers that can help you retire better and pass on your estate while navigating wealth in uncertain times. That's March 11th at the Lafayette Library in Lafayette. The event runs from 6:30 to 8:30 and will focus on retirement income, tax strategies, estate planning, and tax planning. If you're nearing or you're now in retirement and have at least $500,000 in investable assets, this seminar is for you. Stephanie will explain how to transition your portfolio from the accumulation phase to the income phase, which accounts to draw from first, how to protect your estate from long-term care costs, and much more. Learn how to invest during inflation and interest rate moves. Also, Social Security strategies and managing IRAs and 401ks in retirement. Rob Black will share market happenings and trends. Navigating wealth in uncertain times is appropriate for individuals with at least $500,000 and either in or heading to retirement. Wednesday, March 11th, 6:30 to 8:30 at the Lafayette Library in Lafayette. Sign up for the event at robblackshow.com.